some updates from the biggest story of today. Iran's attack on Israel. And this is clearly something that is important to markets as the S&P fell almost 1% today. But let's start with this video, Wall Street's perspective on how Iran's missile strikes could impact markets.
Stephen Stanley is chief economist at Santander, and Interactive broker Steve Sosnick is here with me on set. Welcome to both of you. Steve Sosnick, this is a difficult one for equity markets to try to figure out.
Always, Kelly. These geopolitical events are not actually in the equity market's wheelhouse. I look to bonds, I look to oil, I look to other commodities if it's a place where it matters, because that's what bond traders or commodity traders do, is they're laser focused on this stuff. Equity traders focus on revenues, earnings, cash flows of companies, and this is very hard to draw clues from.
Absolutely. I think the tone today, though, has rapidly shifted. It's not just the missile attack. We've also had disappointing ISM numbers this morning. The Atlanta Fed's GDP number was revised lower. People suddenly, just yesterday, the equity index was in the extreme greed territory. You wake up today, and it feels as though it's a reset.
Somewhat, yes, although advanced decline is actually not overwhelmingly so. When I looked at New York advanced decline just a few minutes ago, it's like 15 to 23 plus or something like that. So it's not an overwhelming sell-off. This is part of still the rotation going on, although we're seeing it, which is why you're seeing the underperformance of the big cap tech. But this is definitely the kind of environment now where you do have to be more concerned with fear. I think we were finishing out the quarter with a lot of greed, and for good reason. It was a great quarter to be greedy. Now we have to think about whether to reset a little bit there.
Stephen Stanley, are you looking at any pressure points from this conflict vis-a-vis oil onto the U.S. economy? Or again, I didn't even mention the port strike that happened that began at midnight.
Yeah, I mean, I think anytime you're talking about the Middle East, the first thing that markets are going to consider is the price of oil. And as you say, we've seen it go up a little bit, although before today, oil was about as low as it's been. The price of oil is about as low as it's been in a few years. So it doesn't feel like this is going to be a huge stress point on the economy, but it depends on how far this goes. I mean, Israel is not an oil producer. Lebanon is not an oil producer, but Iran is. And so if this thing escalates, as Mike and Ed were discussing, if it escalates to a point where Iran is under direct attack, then presumably the oil markets are going to be affected more significantly.
Of course, and any jump for the U.S. consumer into the holiday as well is going to be one that is not taken kindly. That said, we got job data this morning that tells us hiring is still a little bit weak. Yes, there's more job openings than there were, but we'd like to see that pace pick up a little bit, I guess, to assuage concerns about the economy. Do you think rate cuts will help in that regard and kind of help guarantee that we can try to pull off some kind of soft landing here?
Over time, I mean, it's, as Milton Friedman said, there are long and variable lags, and I think it will take a while for the rate cuts that have begun to take full effect. So I think the economy is probably in for a bit of a soft patch over the next 2 or 3 quarters, but I'm hopeful that by the second half of next year, that lower rates will help to get us back on track.
And finally, on the inflation front, do all of these skirmishes and sort of supply chain issues, does the escalation in the Middle East all add up to a more significant event on that front, or do you think we can still continue the downward trend?
Well, I think the thing there to keep in mind is that the genie is a little bit out of the bottle in that inflation was very low and well contained for many, many years. And then the pandemic came along and we saw inflation flare up. And I think there's a little bit of muscle memory there. Now, firms kind of know what to do when there's a supply disruption, and that is to try to raise prices. And so we can't be quite as sure today as we might have in, say, 2018 or 19, that an incident like the port strike or a jump in oil prices won't have lasting effects on inflation. I think we could have written that off pretty easily prior to the pandemic, but now I think we'll have to see.
Yeah. Does it make you want to own smaller companies, Steve, like we were talking about small caps? Because yesterday we were speaking with Dan Suzuki, who is in favor of small caps and materials and kind of the stickier inflation narrative. But I keep going back to, if that's true and rates are on the margin higher, the earnings power of the Russell 2000 falls significantly. So it feels as though, how do you own it sort of with sticky inflation, but want to avoid it if we have higher rates?
This is the problem I have with small caps, is because the narrative is so fluid, because you can make a case for them either way. And part of it is just because the size of the Russell 2000 fits neatly into some of the mega cap stocks. So if money flows, it's going to move. But I don't see this as being a great environment for small caps. They don't have a lot of pricing power. They don't have a lot of market power. In many cases, because they're not particularly profitable, they're very reliant upon rates. And so if we're talking about a soft landing, we're not talking about the sort of robust economy that lifts all boats. So I'm very cautious on them. I can't necessarily be outright bearish on them because, again, if the money flows, it flows in, they're going to move up. But there's not, to me, a compelling reason for that to happen.
Understood. It makes sense. Gentlemen, thank you. Steve Sosnick and Stephen Stanley. Thank you. I got all my S's correct. We really appreciate your time.
So first, on the Iran strike on Israel, it looks like Israel is going to retaliate, potentially with the United States. And some people are saying that this could start the end of Iran's, I guess, ruling in the Middle East. And I do think in the end, if you've been an investor for a while, you kind of know that over time, geopolitical tensions or problems or wars really are never big catalysts for markets because, again, people are always trying to, figure out what cash flow is going to be like and profitability is going to be like. And it just doesn't tend to affect those things for a long time. Now, what's actually interesting about right now is the economy seems to be on the edge of what could be a recession. What normally happens right before a recession is you get a spike in oil. If we do see oil go through a larger spike heading into the holiday season, that's really going to be problematic for people, for consumers. It's going to take money out of their pockets when they're already stretched. They're already, struggling by many different metrics. And that's just going to become another problem for people. And it can influence people's decisions as well. People, may have otherwise been like, hey, let's go do this or let's do that. I can afford that. But then if they're trying to factor in gas, that's $4 or $5 a gallon, right? Compared to $2.90, $3 where it is today, that can just turn some people off and make them not want to go do that thing. So I think for oil markets specifically, this Middle East conflict is something worth paying attention to. U.S. National Security Advisor Jake Sullivan has just stated that Iran will suffer severe consequences for tonight's ballistic missile attack against Israel, and that the United States will work with Israel to make sure that is the case. On the other hand, I'm glad they pointed out the weakness in the manufacturing numbers that we've seen today, especially the employment, but also the weakness in the JOLTS report. Yes, job openings, there's more of them, but you can see here, job openings, schmo openings, this JOLTS report confirms a pretty rapid cooling in the labor market when you look at the hire rate and the quit rate that are both moving down at a pretty rapid pace. You can also see here in an expanding economy and a bull market, you tend to see private hiring actually going up. It's not anymore. It's been falling for a while and continues on a downward trajectory. Ryan Dietrich just wrote on X, he says the S&P 500 up 20.8% heading into October could mean we finally see some red. With October lower 7 of 9 times, stocks were up 20% or more heading into this spooky month. This isn't a bad thing though, as Q4 tends to still rally, and we'd expect this to play out again in 2024. The CNN Fear and Greed Index is now at 69 today. Yesterday, it was at 75, barely in extreme greed territory. Market momentum is greed, stock price strength, extreme greed, stock price breadth, extreme greed, put and call options, extreme greed. Market volatility is neutral, safe haven demand is extreme greed, and junk bond demand is in extreme fear. And here you can see we did break above the 50-day moving average again on the VIX. And when you tend to do that, you tend to see a larger spike in the VIX. So just judging off of historically what we've seen, this could be another larger round of selling for markets. Now, that really wouldn't be too uncommon because it's October. You tend to get that election correction in October, not to mention the problems over in the Middle East, not to mention the port strike. I mean, yeah, there's not a huge bull case right now if you're investing in markets. The percent of stocks trading above their 50-day moving average is at 57.71%. You fell about 7.5% today. So today was a pretty rough day for the internals of our markets. The latest AI investor sentiment survey shows 49.6% of investors are bullish, 26.7% are neutral, and 23.7% are bearish. And one of the biggest stories today is the VIX closed today up over 15%, which is a crazy move for the VIX. You could see the gold was also up about 1%, and oil closed up almost 4%. And apparently gas stations across Iran are said to have miles long lines as Iranians rush to get gas before an Israeli attack that may target the Iranian oil industry. Now, assuming nothing crazy happens overnight tonight, which I would not rule out, tomorrow, the biggest set of news we will get is the ADP employment change. This is data from the private sector, basically non-farm payrolls, but not government numbers. We're expecting about 90,000. Last month, we came in at 99,000. Some estimates are as high as 120,000. So we really want to see a good number here. As high as possible would be welcomed. Now you have Fed Hammock, Fed Mausoleum that speak, couple other Fed speakers like Fed Bowman, Fed Barkin, but that's it for your day tomorrow. So let me know your thoughts on all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.